A few weeks back I saw a question about BMV, or below market value, and it really piqued my interest. So I've looked into it a little bit more, and sure enough, on most social media platforms, if you put in the expression below market value, you're going to see a lot of activity and promotion around this entire concept. So what I want to do now is just take a look at whether there is any truth in this idea of below market value, or whether it is a falsehood that should be actively avoided, or at the very least treated with a lot of caution. Hi, my name's Edward. I'm a chartered surveyor, and up until recently I was an associate lecturer teaching university students real estate investment finance and property valuation. Right now I work in the city. I am the head of investment finance for a property division of a FTSE 100 listed company. And the whole point of telling you that is that hopefully I've got a good depth of both practical and theoretical experience that I can share with you to help your property investment journey go a lot more smoothly and be a lot more profitable. All right, so this concept then of BMV, below market value, well, what is it? Below market value is the idea of acquiring a property at a price that is demonstrably lower than the price at which other properties surrounding it have recently been sold for. That's it. You're essentially beating the system, or at least that's what people will have you believe. Most of the time, for a property to sell or transact, we need to have a willing buyer and a willing seller. And again, it follows that most of the time a willing seller is generally aware of the value of their property. So it follows on again then that for a willing seller to knowingly sell their property at a price that is below market value, it means that there's probably a reason for that. And that's important. The most typical reason for a property to sell at a price that is lower than the properties surrounding it is condition. Back in 2017, I think it was, there was a case of a multi-million-pound Mews property in Little Venice in London that was on the market for around about 2 million, but it was in a dilapidated condition. And so my point is, the purchaser of that property would have to spend 2 million but invest more money to bring it up to a standard that would then bring it in line with the rest of the market, which evidently was a lot more than £2 million. So the point here is, if a property needs refurbishment and it therefore needs money spent on it to bring it up to standard, you're not buying it at below market value. You're buying it at market value for a property that requires further investment in renovation. This concept isn't limited to residential property either. It applies to commercial property as well. So let's consider pubs for a quick illustration of this. This building behind me used to be a really popular pub back in the 1990s and early 2000s. But in the last few years, it's lurched from owner to owner who've tried to sort of invest in it, give it a bit of life and energy, but every single time it's stuttered and failed. So right now this building is vacant and it will probably come on the market, if it isn't already, quite soon. Structurally as well, I know there are a few problems with this building. So the price you would buy this one for would be well below the price you would buy this one for. And that's because this is actively trading. It's got a really good reputation, and it's in a really excellent location with lots of passing trade as well. So it's not to say that if you bought this building, you'd be paying above market value. And if you bought the previous building, you'd be paying below market value. You would be paying market value for the type of property and the condition it's in. And that includes its commercial condition as well. What about these situations that we hear about where people claim to be buying below market value, but they're buying brand new stock? So they're buying the last 10 flats in a development of flats, or they're buying the last 10 houses on a housing development. And they're buying those at rates or prices that are below the price at which the other flats or the other houses have previously sold for. Well, on the face of it, that looks like below market value, but there are a couple of things to consider. The first one is that the developer is probably highly motivated. The reason why a developer will be highly motivated is that chances are they've borrowed money from a bank, and development finance or construction finance is typically a lot more expensive than a standard commercial loan on the existing commercial property or a residential mortgage on the existing residential property. So it makes sense then that if you are prepared to go to that developer and offer to buy their remaining units on their scheme, they're very likely to bite your hand off so that they can finish that scheme and pay down those pesky bank loans. And then we have to consider something which happens on almost all schemes. It doesn't matter whether they're flats or houses, anywhere in the country, it doesn't matter. But that is an inverse in the supply-demand relationship. So typically you will see all schemes being heavily marketed, and that marketing activity will happen before the scheme is even completely built, and so you will see a big push on sales initially and then a slowdown in sales activity. So when you're sweeping up the final 10 units in a block of flats or the final 10 houses on a development, is that a below market value opportunity, or is it actually buying the properties at the prevailing price, i.e. the price at which they would normally sell if you remove the fact that there was a massive marketing push and they were brand new to the market? So in that situation, you're not actually paying the premium for brand new property at the height of a sales cycle. What you're doing is waiting a bit and paying the prevailing price for new property after the initial flourish of a sales cycle. Then finally, we need to tie up those last two situations, so the cost of bank debt for the developer and that supply-demand inversion taking place, with the fact that anyone that says they're buying below market value but they're buying 5 or 10 units in a block of flats or 5 or 10 houses on a housing development scheme, what they're actually doing is buying in bulk, and you're therefore achieving a bulk discount. Bulk discounts apply across almost all commodities in almost all markets, and that makes a lot of sense, right? Because if you're offering to go and buy high volumes of something, then the seller is quite likely to be welcoming you with open arms and give you a discount for doing that. So don't confuse that bulk discount with buying below market value, because actually you're distorting your vision of what's actually gone on. Now I'm certain in fact that those two illustrations I've just given about the condition of a property and its reduction in price, and buying properties in bulk at the end of a development cycle, probably have raised a few eyebrows, created a bit of debate. And if you don't agree with what I've said, please put it in the comments below, because actually we need to talk more about this. We need to have discussion about this so that we can actually get clarity on this issue. And I suppose one thing we can do to get absolute clarity on whether a property has been bought at below market value is to conduct the following exercise. So imagine, if you will, a whole series of properties that we know because of recent sales have all sold in the region of £200,000. And then take it one step further and imagine that one of those properties you have agreed to buy, you haven't completed the purchase, you've just agreed to buy for £125,000. All right, so that represents a huge discount to the prevailing market price. But have we bought that at below market value? Well, the way to test that is as follows. What I'm challenging you to do is sell that property without any interference of refurbishment or bulk discount, and that you are going to agree to sell that for £200,000. If you know that you can definitely do that deal, then yes, you have proven below market value purchase. And well done you, because that is the exception, definitely not the norm. And because it is the exception, I would argue that pursuing a strategy of trying to buy properties at below market value is probably a fool's errand. I do not mind admitting that my aim here is to grow this channel, and the way I do that is by attracting more subscribers. So if you want to help me grow this channel and you like what you're seeing here, please hit the subscribe button. I'd really appreciate it, and it would help me enormously. Surely there has to be a situation where property can be legitimately proven to be below market value. Unlike condition, timing does open up some genuine opportunities for below market value purchases. And specifically, what I mean here is where you have a distressed seller or a highly motivated seller. Remember that relationship, willing buyer, willing seller. There are some times in life when a willing seller is motivated. They've got to sell that property quickly for reasons that we don't need to be concerned with here. But what we are concerned with here is their motivation to sell might create a situation where they'll sell at a discount to prevailing market rates. So if you buy a property from a motivated seller or a distressed seller at a price that is lower than the price at which other properties of a similar condition have sold for in the area, that could be highly advantageous to you. That is probably a genuine situation of below market value purchase. And what can you do with that? Well, what you can do is you can get your property valued by an RICS, a Royal Institution of Chartered Surveyors valuer, who can then confirm in writing the price you paid and the price of the surrounding properties. So to conclude then, 99% of below market value stories are probably just completely unnecessary flexing. I would argue, in fact, I would encourage anyone interested in property investment to have regard to the concept of below market value, but certainly don't make it a core strategy that you're going to follow, because I think you'll probably come unstuck quite quickly. However, if you do find yourself in a situation where you have bought a property off a distressed or motivated seller and you can clearly see that you have got a property at a very, very good deal, then yeah, capture that with an RICS valuation, maybe use that for some advantageous debt financing, but make it the exception, not the norm. In the meantime, if you've got questions, please do put them in the comments below, or please email me. I love getting your questions. They help me frame subsequent videos, and it's just great to keep the conversation going. Have a great day, and thanks for watching.